In the last 45 years, there's only been a handful of times that this has happened. The top line is the S&P 500, which tracks the stocks of America's biggest companies. Google, Nvidia, Microsoft, Tesla, MasterCard, you get the picture. It's what most people mean when they say the stock market, because even though it's just 500 stocks, it represents 87% of the value of all publicly listed companies. This piece of the stock market is the small cap companies. They're grouped together in the Russell 2000 index, and that's the other line on this chart. In the last 2 weeks, the small companies have surged in value while the bigger companies have started to fall.
So we think that this move could be something like 10 weeks and as much as 40%. So I think it is just starting.
In finance speak, this is called a rotation. Huge amounts of money moving out of one group of stocks into another group. But this particular move is so rare that it's being called the Great Rotation.
I think that August is really going to be one where the rotation becomes more evident.
So why is this happening? And what does history tell us about what's going to happen next? So we know that the value of American companies is extremely concentrated. Just 500 companies represent almost all of it. But it's even more concentrated than you probably think. The stocks in the Russell 2000 index have a total value of about $3 trillion. That means that both Apple and Microsoft are each more valuable than all of the small cap companies in the United States. These two stocks and the other big tech names have gotten all of the attention from investors this year. It's one of the reasons why the S&P 500 is up over 17% this year, and why, as of 2 weeks ago, the basket of small cap stocks was up less than 1%. But as you can see, in the last few trading days, that gap has closed very quickly. And there's actually 3 distinct factors that explain the rapid movement. The first is valuation. The S&P 500 has become increasingly expensive since late 2022. And when I say more expensive, I'm not just talking about the S&P 500 going up in price. I mean it's getting more expensive relative to their profits. The price to earnings ratio of the S&P 500 is just under 29. That's almost double the historical average. But the S&P 500 has also become more expensive relative to small cap stocks. The prices of small cap stocks are cheaper than large cap stocks when compared to their expected 2024 profits. And that's the opposite of what we normally see. Small cap stocks are typically more expensive relative to earnings than large cap stocks because they have a greater opportunity to increase their profits in the future. And so throughout 2024, small cap stocks have increasingly become more attractive to investors.
We just think the valuations in the big, in the Mag 7 and really probably the Mag 5 only are stretched, and we want to look some other places over the next 18 months.
In the first half of 2024, more than half the return of the S&P 500 came from just 4 stocks: Nvidia, Amazon, Microsoft, and Alphabet. These particular stocks and a few others have become increasingly expensive throughout 2024, and so institutional investors have recently taken the opportunity to trim some of their positions. Nvidia, Microsoft, Amazon, and Alphabet are all down in varying amounts in the second half of 2024. Those 4 stocks alone have pulled the entire S&P 500 down 1.1% in the second half of this year. Some of that money has gone into small cap stocks, and it doesn't take much to drive the Russell 2000 up. The index is just 1/15 the size of the S&P 500, so even small amounts of money rotating out of large caps can make a big difference. But the so-called Great Rotation isn't just about valuations. That's only a small part of the broader shift we're seeing. There are other major changes at play that largely explain the sudden rise in small cap stocks. The Federal Reserve, corporate bankruptcies, the US election, and many more are responsible. So I want to paint a picture of exactly what's happening and explore what it means for the stock market's performance over the remainder of the year. But before I do that, I am just going to pause the video quickly to talk about the sponsor of today's video, BetterHelp. I've partnered with BetterHelp this year because mental health is something that affects pretty much everyone, and I've been able to overcome some of my personal challenges with therapy. Almost all of my audience are men, and we in particular can have a tough time opening up to the people around us. On a personal note, building strong business relationships is a really important part of my career and what I do here, and as someone who's dealt with social anxiety my entire life, life, at times it's held me back. And sometimes you just need to reach out for help, and therapy is one of the best ways you can do it. It's a safe space to talk through your mindset and thoughts, and I think the most valuable thing for me was hearing new perspectives on what I was going through. If you're struggling with something in your life, maybe it's anxiety or depression, know that seeking help is a sign of strength, not weakness. And that's where BetterHelp comes in. They offer online therapy with a wide network of licensed therapists who specialize in different areas so that you can find the right fit for your needs. With BetterHelp, you can communicate through video chats, phone calls, or even messaging. Plus, you can switch to a new therapist at any time at no additional cost. BetterHelp is making therapy more accessible and convenient than ever. If you're interested in giving online therapy a try, go to betterhelp.com/Hamish Hodder or select Hamish Hodder at sign up for a special discount off your first month. Investing in your mental health is one of the best things you can do for yourself. Don't be afraid to reach out for support. The big move upward for the Russell 2000 started on the 11th of July, surging more than 3% on the day. It was triggered by the release of the June Consumer Price Index data from the Bureau of Labor Statistics. It showed that headline inflation had fallen to an annual figure of just 3%, the fourth slowdown in a row. But even more importantly, the CPI actually declined in the month of June. The inflation story in 2024 has been an absolute roller coaster. It was actually rising at an alarming rate in the first few months of the year, but since then it's cooled off in a meaningful way. The good news means two things for stocks, one that affects stocks broadly and one that impacts small caps and the Russell 2000 specifically. First, generally speaking, with inflation now trending very closely to a healthy range, the likelihood of a Fed rate cut has increased considerably. Back in June, the Federal Open Market Committee projected they'd be cutting rates between 0 and 2 times this year. If they do cut rates, it'll increase the value of stocks across the board. The yields of asset classes are all connected together, so if the yields on US government bonds, for example, go down, then the yields on stocks go down. And since the yield and price of a stock is an inverse relationship, lower yields means higher prices. And because the market functions on future expectations, stocks move up before the actual interest rate change occurs. But there's actually a more important reason why lower interest rates is particularly good for small cap stocks. As a group, they have much higher debts than large cap companies.
Companies were burdened with capital structures, debt structures that did not anticipate a 500 basis point or 400 basis point increase in rates.
Until very recently, it was actually very cheap for businesses to borrow money. So particularly for smaller companies with a wider array of opportunities to invest capital to grow, they've been building up their elevated debt levels for quite some time. And many of the small cap companies are unprofitable, so they've been borrowing money to keep an unsustainable business afloat.
It was a great time to be a borrower because rates came down and business was prosperous.
But in the last 2 years, companies have been thrust into a completely different environment. One with higher material and labor costs, and of course higher interest payments. As of March, business bankruptcies have increased by over 40% in just 12 months, with more than 20,000 companies filing for protection, almost as many bankruptcies as there were in 2020. And the bad news for debt-burdened companies continued in early 2024, with inflation coming in much hotter than was expected. Interest rates were expected to stay higher for longer. And that caused small cap stocks to lag the S&P 500 in a pretty big way. So all of this is to say that the latest inflation reading that has been very positive is a big deal for the Russell 2000.
The June CPI was so astonishingly soft. I think it's giving the green light for small caps to rally finally because the Fed will ultimately cut, hopefully by September.
The final force behind the rotation into small cap stocks was actually the Trump assassination attempt. I'm not going to go into the details of the shooting because I'm pretty sure everyone is quite familiar with what happened, but I will talk about why it matters to the stock market. Since the shooting, the likelihood of a Trump presidency has gone up considerably. National polls have Trump more than 3 points ahead of Biden as of the 21st of July, and as I'm recording this, Biden has announced that he won't be running for re-election, so we we don't currently know who he's running against, but Trump is probably still the overwhelming favorite. UBS also now ascribes a 45% probability to a red sweep at the election, where not only does Donald Trump win, but Republicans control both houses of Congress. If Trump is elected in November, then it means many of his economic policies could become a reality. In 2017, Trump cut the corporate tax rate from 35% to 21%, and not only has he vowed to keep that in place, but he also wants to lower it even further to 15%. He'll also likely reduce regulations in various ways, both which are good for small companies. As a general rule, small cap stocks tend to be more sensitive to macroeconomic factors than the larger, more established ones. The easiest way to understand why is to think of a stock chart as the market's prediction of a company's future. The less confident the market is about where a company will be in the future, the more its price will bounce around in the short term. Smaller companies that have yet to establish themselves as a dominant player in their respective industry have a much wider array of future outcomes. The divergence between the S&P 500 and the Russell 2000 that started in July is pretty rare, and history tells us what we could expect to happen next. Research from Bespoke Investment Group found only 12 occurrences since 1979 where the S&P 500 underperformed the Russell 2000 by more than 3 percentage points on the day. 1987, 2000, 2008, 2011, 2020, 2023, and of course 2 weeks ago. The percentages next to the red dots indicate the 1-year performance of each indice after the event. So with the exception of the year 2000, both the S&P 500 and the Russell 2000 have had strong performances. The Russell 2000 also outperformed the S&P in 4 out of the 7 periods.
So we think that this move could be something like 10 weeks and as much as 40%. So I think it is just starting.
So this seems to suggest that the market is going to be good to investors over the next 12 months. But there's also some pretty big caveats that are important to address. The historical data on this is limited. We're talking about a handful of times that this has happened, and it's kind of arbitrary how the points are selected. Since 1979, there's been about 11,000 trading days, so you could pretty easily find any kind of pattern. Patterns that simply exist out of randomness. And in my experience, stock price movements in the short term are pretty random, and they're random because they're influenced by a basket of factors that are just unpredictable. In the next 12 months, for example, we have a US election with an unknown Democratic candidate, unknown interest rate changes, unknown inflation rate, and a huge number of other things. These kinds of market events are interesting to me, and I think they help me and hopefully you as well understand a little bit more about the economy, but they certainly don't influence my investing decisions. Subscribe if you enjoyed and check out some of these videos next.